Hello, my name is Frank Little. I am a real estate investor and agent in the greater Baltimore, Maryland area. I recently had a conversation with a Mr. Neil Schwerin, who is a reverse mortgage specialist. And although I myself and others out in the marketplace have heard of reverse mortgages, here we have a 30-minute conversation where we're talking about the difference between a standard loan and a reverse mortgage, when is it used, and how it is a financial vehicle. So, if you can, please just go ahead and like, share, and follow this video so that you'll be notified when I put other videos out because I will be discussing a myriad of topics in the upcoming sessions. So, enjoy. All right, hello everyone. This is Frank Little, agent and investor with Brookshire Hathaway. Today I have a guest that I want to share with you a particular product that has been in the market for some time. Recently, I took a class on reverse mortgages, not only to diversify my skill set, but also to gain knowledge because I have relatives who have reverse mortgages. So I want to introduce you today to Mr. Neil. I want to make sure I say this right. Schwerin.
Swearing, that's
All
correct.
right, Neil Schwerin. He is a senior loan officer, reverse mortgage specialist with Atlantic Coast Mortgage. All right. Thank you so much for joining me today.
Thank you for
As we always do when we have guests come on, we start off with a brief introduction. Pretty much, I already gave your name, but your name, your company, and pretty much how long you've been doing it.
First of all, thank you for having me here today. My name's Neil Swearin. I've been a residential loan officer for 35 years. It's all I've ever done right out of college. Been, I, I'm going to say in 2006-ish, I got introduced to the reverse mortgage product through a relative of mine who I tried to talk out of pursuing it. And she said, well, I'm pretty sure my parents are going to do this anyway. So if you could do the research for me, I'd appreciate it. And digging deeper, I learned a lot about the product that wasn't at all what I thought it was. And it turned into my life's work. Now all I do are reverse mortgages. I work with seniors and aging in place strategies, trying to figure out both strategies for being able to right size to more age appropriate styles of housing, be closer to family, a lot of our clients, as well as trying to help people figure out how to most affordably stay in their own homes as long as possible and make their money last as long as possible.
So I think you touched upon a few things, and I thank you for jumping right into that. When I took the class, I'm going to be honest. I came in, I was a little bit skeptical, and the reason why I was skeptical is because regretfully in reflection, it was more me than anything. It's you hear something and then you become hypersensitive to it. So I heard reverse mortgages when my grandparents said that they decided to do it. Grandfather worked in a steel mill for 30 plus years until it ran out of business because steel was cheaper to be made overseas. He's been in his house since 1982. My grandmother recently died in February of 2023. And I just knew it was like, all right, we call him Pop. I was like, Pop, it's time for you to, you're not gonna fight these stairs anymore. And when he said, no, I'm gonna stay in my house. And he's 92. We do have a relative that lives with him, but I just always figured that every day he's in that house, he's losing. But after coming to your class and seeing something a little bit differently and educating myself, like I always try to get my viewers to do, I learned that reverse mortgages are exactly what you said. The intent of the product is for it to keep people in their homes and having a certain quality of life. And I think you said it was stay in place. Is that what you said it was?
Aging in place.
Yeah, yeah. So it's not so normally you think stay in place means you don't move. No, it means you are independent for as long as you can. And what this product does here is if used properly, it can allow seniors just to do that. Like you gave some statistics about baby boomers. Like I spoke to my mother. Baby boomers, if I'm not mistaken, I don't have my notes in front of me. I think was what right after the wars. That's what 46 to 64. The years
64.
1946.
Yep.
All right. My mother was born in 51. I hope she doesn't let it. I hope she doesn't get me for that. But
You're in
'Cause I
trouble.
spoke to her immediately after your class, and I spoke to her about this product too. And what she said to me was, I intend to stay in my house as long as I can. She had it built probably about 10 or 15 years ago from the ground up. And that was, one of her life's dreams was to have a house built. So she achieved it and she wants to hold on to it as long as she can. So when you say right size, like you said, you want a right size, you want people to stay in place. What does right size mean?
So a lot of our clients, they're in homes that were appropriate for them when they had, a family. They had kids living there. They had active, all kinds of stuff going on. They needed the space, the style of housing with steps you mentioned
Mhm.
before, was not an issue. And, you know, as we get older, first of all, do we need all that space? It's a lot to maintain, even if I live in a rancher and it's a nice house. I always say I could live here forever, but it's a lot to take care of. I got a yard. I don't like to cut the grass, so paying somebody to do that. It's a long house, so it's got two HVACs, and it's a lot to maintain. It's got a huge roof on it. Repairs are expensive. So, as we get older, like, do we need all this space is really the question. So if we have a lot of steps and it's not something we can, can you modify the house to your needs? If you have steps and you start to have an issue with the steps, can you put a chairlift in? Because that solves a lot of problems for people. Can you move your living? Can you put a bed down on the first floor if necessary, even for a short period of time? Let's say you're in rehab. So these things people don't really think about early on, but sometimes it becomes a challenge later, as we get a little older, both financially and physically, to deal with the space that we're in. So most people do want to stay in the house that they're in, but also we look at, I go to see a lot of my clients in their homes and they've been there a long time. The house is dark. It's got a lot of stuff there. They don't move because it's an overwhelming task. Look, I don't know, it's overwhelming to move when you're 30. When you're 60, 70, 80, like, moving is just a tremendous task. Think about what that sort of undertaking is like if you don't have a plan and good help and know who to reach out to for assistance. So, people don't really want to move, but they also don't want to go into what I'll call a facility. They want to live independently. Most people would like to do that as long as possible. And that's sort of, I'll segue here into this product. Even my friends will say, Neil, I don't understand why anyone would do a reverse mortgage. Why don't they just sell the house and rent? Okay, run the numbers on that. Rent isn't what rent was when you got married 35 years ago, or whatever it was. People aren't paying $900 a month for rent. Anywhere you would want to live is going to be how much? $2,000, 1,800, like,
Sometimes
and if you
that's on
need
the
a
low
building,
end.
that could be on the low end, depends on where you are. But no one moves from a $400,000 or $500,000 house to an $800 apartment. That's not what we're doing here. People want to live in, maybe they want to live in a nice condo, but then they don't have the maintenance to deal with. They're just happy to pay the couple $100 a month, condo fees, but they don't want to have to do the maintenance and things themselves. So this product allows them to sort of rearrange their finances so that they're not having to deal with the mandatory monthly debt service that all other types of financing have associated with them. You don't have to make a monthly payment with a reverse mortgage. You can, but you're not required to. So, people say, all right, so we're trained to believe, like, okay, well, then if I'm not making the payment, then the balance is growing and that's bad. Okay. Is it? Because we're taking the money from somewhere. We have either a stream of income, Social Security, pension, whatever that is, and we're taking that income every month and we're sending it off to cover the mortgage payment if we have a mortgage. So what if that stopped? What if you could keep that money? Yes, the balance is growing on the one side, but you're holding on to more of your income on the other side, or it's helping you afford to be able to live independently in a situation where the other options let's say assisted living. Do you know how expensive that is? If you think rent's high, take a look at any other option that involves some sort of assisted living type of arrangement. It's extremely expensive. The longer you can stay in your home, even with the reverse mortgage, the less you're going to spend of assets if you have them. If you don't have assets and we're working off of cash flow, even more important to preserve as much of that cash flow as you can for both quality of life and affordability.
Yeah. So
That's a lot.
like that's a lot, and let's unpack that just a little bit. So what I am thinking is, I'll use my grandfather. Income is not really a problem. Okay, it's about the quality of life. And when my grandmother became sick, there were some medical bills and things like that, but that was pretty much kind of taken care of. But what you're saying here is that what this product will do is will stop the monthly payment that would have to go out for living expenses in terms of mortgage. And what that does is those funds could be freed up because gas is not as cheap as it used to be, food, medication, things like that. Because most of the time, your biggest expense is where you live. So this product, when used properly,
It,
go ahead.
Frank, it'll allow people, the easiest way I can sort of summarize is it allows people to make financial decisions from strength rather than weakness.
Excellent.
Weakness is, this is my monthly payment. You got to send that into the bank every month. It doesn't matter if you have a tough time, if you get sick, you need to pay for some, help your grandchildren or your children with something. It doesn't matter. You can't just stop making your mortgage payment, right?
True.
With this, you have the flexibility. You can make the payment every month, but then let's say something happens. Let's say your spouse passes away or you have some other needs you need to meet. You can stop making the payments. You can draw funds back out of the loan if you need to. It's just incredibly flexible.
So,
can we just back up? Can we just back up a little? So I want to make sure we're clear with what the difference is between a reverse mortgage and a traditional loan.
Mm-hmm.
Okay. A traditional loan, we all know how that works. So you borrow X amount of dollars and then you pay it back over a certain scheduled period of time. A traditional mortgage, 30, 15 years are typical. You borrow $100,000, your payment's $600 a month. You pay that $600 principal and interest every month till the loan's paid off. You can pay extra if you want, but you can't pay less than that minimum payment.
Uh-huh.
A home equity loan, you borrow money as needed. Let's say you set up a $100,000 line of credit. Your payment is based on how much money you draw. So the more you take, the larger your monthly payment expenses. Typically, those are interest only for the first 10 years, and then they after 10 years, they hit a pay down period. So another 10 years, you're paying it down, whatever the balance is. If your balance is $100,000 after 10 years, now you have a 10-year payment for $100,000 to get that paid off. So that's how the traditional loans work. And most people understand those concepts, and that's fine. And they work great when we're in our 20s, 30s, 40s, even 50s. That's fine because we have income coming in. We can go and earn extra money if we want. Many of us, you have some flexibility in your finances. With a reverse mortgage, same principle. You borrow money, there's a lien against your property. So when the house gets sold, the loan gets paid off. The difference is that monthly payment is not required with the reverse mortgage. As I mentioned before, you can pay on it, but you don't have to. So you can take money any one of three ways: a lump sum at closing, which typically will pay off any existing debt or help pay for the purchase of the property. Okay. You can have a line of credit where you take money as needed, and you can have monthly payments made to you out of your available funds on a regular basis. You can combine that. Those three can be any combination of those three. So typically in a refinance situation, if I approve someone, let's say for a $300,000 line of credit, they may owe 100 on the property. So we're going to pay off that 100 and eliminate that debt. And then they'll have 200 available in a line of credit. They can take some of that month. If they said to me, well, Neil, I'm $500 short every month making ends meet. So I'd like that $500 automatically deposited in my checking account. Great. So we'll set up for the $500 automatically. And then there'll still be a segment of that loan that's a line of credit that can be borrowed as necessary. Or they can just leave it all available in the line of credit and take it as needed. If in a year they need a roof, they need 30 grand or 20 grand to pay for a roof, they take the 20 grand, pay for the roof, and still no payments are required regardless of when the funds are drawn.
Okay. So
Make
I have a
sense?
question. You said that if they want to make a payment, they can. So when you originate this loan, do you either opt in that I'm going to make a payment monthly, or do I have the flexibility to pick up the phone and say, call hypothetically, it wouldn't be you, but call somebody and say, hey, look, this month I don't want to make the payment.
Good question. So you don't even have to call. There's no opting in. Every month you get a statement, just like you do with a traditional loan. It'll tell you what your starting balance was, any loan activity, and the ending balance. If you send in a payment, it'll show you the reduction of your principal balance. If you and dollar for dollar, every dollar you pay on the loan becomes a dollar that is available in your line of credit to borrow back later.
Okay.
So I think I told the story in the class. I had a client who were husband and wife, both in their 80s. They wanted a 15-year payment schedule. So for whatever reason, they wanted to make sure the house was paid off when they turned 100. So this was a great product for them, because should something happen to either one of them, they're 85 going into this, should something happen to either one of them, they can stop making payments or they can start drawing money, but they can make payments as long as they're able to, if they choose. So they've been making payments for several years on this loan, and now they have over $100,000 available in their line of credit that they can borrow back if they ever need to. They don't have to ask permission to stop making payments. We don't expect payments. That these loans don't show in your credit report because there's no obligation to make a payment. So they pay if they want. They don't pay if if Christmas time comes and they have some other expenses that they want to take care of. They can not pay that month. We don't care.
Okay.
It's actually easier for us if they don't pay it.
Okay. So basically this is a lien, is what you're saying. Is that
It's a mortgage, just like a traditional loan. It's a mortgage. It's a lien against the property.
All right. And it has to be in the first position, correct?
Has to be in first position, and there can be no other debt on the property when we go to closing. So we have to satisfy any liens that are on the property have to be paid at closing.
So that's for a point of clarity, I want to make sure I get this right. So I'm going to refinance with and get a reverse mortgage. I have a small mortgage on the house. Like I just hypothetically, I use myself. I have a rental property, owe about 65 grand on it, right? I decide, if I was old enough, right, to go ahead, get a reverse mortgage on this property, and it has to be my primary residence, correct? All right, so it has to be my primary residence. First thing we're going to do is pay off that 65 grand that I owe, so that the reverse mortgage becomes in the first position. And for those of you who do not know, when you have liens put against the property, there's an order. So if the property, I guess, falls into foreclosure or into trouble, the lien order matters. Is that correct? Is that a good explanation?
Right. That's right. So let's say you had the $65,000 mortgage, and you also had a home equity loan for $25,000.
That's where I was going.
So,
exactly.
So the home equity loan is in junior position, second position. So the first thing that has to get paid is your primary mortgage. Then we have to pay off the junior lien, the $25,000 home equity loan, and any other funds that were available with the reverse mortgage. You could either take some, or you could take some at closing. You could leave it available in your line of credit. Typically, people take most of our refinance clients are satisfying some initial need at closing, either paying off existing mortgage debt, credit card debt. They have a lot of our older homeowners have a lot of deferred maintenance on the property. So they want to take care of, they might need a new roof. They might need, any number of things. HVAC is very expensive these days. So they'll say, Neil, I need like $30,000 to take care of some stuff around the house that I have neglected for the last 10 years. I got to want to pay off the mortgage, and I've got like 15 grand in a credit card that I want to get that paid off. So great. So we add all that up. We're going to get all that stuff paid off at closing. Other funds will be available, if any, they can leave available in the line of credit to take later as necessary. If they ever want it. If they never borrow it, it never has to be paid back.
Okay. So now let's talk, because you said something in the class that because I said that it changed my perspective. You said a successful reverse mortgage is basically end of life. Like this product, right? We tend to think that when someone passes, we're all going to do it. It's all going to happen. Everybody's going to have a turn at it. But if the reverse mortgage allows you to stay in your home as long as you can before end of life, this product has been successful. Is that how you explained it?
We talked about, right. So technically speaking, that's a default because death is technically a default on the loan because the loan has to then be paid back. But in reality, when we look at it, if someone took out a reverse mortgage and was able to use that product to be able to stay in their home for the rest of their days on earth, then how is that not a success? It worked. It worked perfectly for them. And a lot of times that, one of our biggest frustrations that people are very private and they don't talk to their adult children about their finances in an honest, transparent way. So, the adult children will then call me and say, I don't understand. Mom had a reverse mortgage. They're upset about something, but they're upset because mom didn't really share anything with them. And in many cases, mom was giving the money and paying for things. Maybe she didn't have the ability to really do it, but she told the kid she did. So, I'm then in a position where I have to explain, like, this is what it is. It's how it works. You're not, she's passed. So the house, you don't have to sell the house. In most cases, it does get sold. Very few people really keep their parents' homes. And the only time we really see that are, when the house happens to be, like a beach property or something
vacation
that, has
home
been
where
the
the family is still going to go. Yeah. Okay.
Right. I have some clients that have moved to Bethany and, Cape May, so, stuff like that. And, so those properties, maybe the family wants to keep it and they can keep it. They just have to pay off the mortgage. So they'll refinance it, or they can, sometimes there's a life insurance policy that'll pay off the debt or other assets they use to pay off the debt. But in most cases, the property does get sold. They have plenty of time to sell it. What they can't do is sit on it and wait forever because the balance is accumulating. So it's really not in the family's best interest to play this out for a long extended period of time. Sometimes they call me and say, Mom passed away 8 months ago. I'm getting these nasty letters from the bank. Like, well, what have you been doing for the last 8 months? That, obviously you're looking at the mail. What you got to sell the house. Are you selling it? What are you doing? All the bank wants, all we want, we expect that in a reasonable amount of time, let's just say 30 days, we want communication from the family. What are your intentions? And usually they'll say, I'm going to, we're going to get the house, if the dust settles, we're going to get the house cleaned out and we're going to get it on the market. We say, great, send us a copy of the listing agreement. Once you get it listed, they have, this is going to be oversimplified, but basically they have an initial 6-month period to sell the house and up to 2-3-month extensions, but they have to request and get acceptance for those extensions. And to get an extension beyond 6 months, you have to show that, for instance, the property is, let's say, under contract, but it hasn't closed yet. So you need another 30 days, whatever the time is, or something like that, where there's a reason why that makes sense. It can't be because the house is worth $400,000. You have it listed for $6. We're going to have, a conversation about that. It has to be a reasonable expectations. We will, once the last surviving borrower passes, depending on what the scenario is, we will often send out our own appraiser to appraise the property. And we are required, by the way, because people talk about, it's unusual these days, but you could be in a situation where the loan balance exceeds the property value. You would have to have had this loan for a very long time. In those cases, it's not a short sale. We are required by the FHA guidelines to accept 95% of whatever the house appraises for. So we're going to, when the last surviving borrower passes away, if the family says, hey, listen, we think we would like to sell it, but we're not sure we can get what it's worth, we'll send an appraiser out to the house. An appraiser will tell us this is what it's worth. We'll take 95% of that number as payment in full. And so you, as a real estate agent, you can go out, that this is your number. You can sell it for more if you want, but you don't have to. We'll take that 95% number as payment in full. And the estate is not, even if the estate has millions of dollars, and oftentimes people do have, other assets in their estate, that we are not entitled to that. The house stands for the debt in full. We can't touch anything else. There's no negotiating. It's very simple. If it's a shortfall, the house pays back what it can when it's sold, and FHA pays us back the difference. So as a lender, we're made whole through the insurance fund. And our client, all borrowers contribute to the insurance fund. That's the FHA mortgage insurance premium. And, it's not a taxpayer funded program. And that's what it's for.
Yeah. So that's a very good point. I want to make sure that we touch upon this in some of the time that we have left. So basically this is a FHA guaranteed program, correct? So basically what that means to the novice borrower is that the federal government is basically backing this loan, correct? Is that how it's explained or no? Yeah. So it's back. It's
FHA is an insurance. FHA is an insurance program. So the loan is insured to motivate us to lend this money. FHA says you're okay. You're gonna, as long as you lend under these guidelines, no matter what happens, if there's a shortfall in the end, we'll make you whole.
Got you. So when you said 95%, what you were basically saying here is the company will satisfy for 95%, satisfy the loan, the reverse mortgage. FHA handles the other 5%. That's what all borrowers pay into with the FHA insurance program. The deal is done. The house is either sold or it's been refinanced and they moved on. Correct?
Yes.
Excellent. All right. So we have about 10 minutes left. And what I wanted to do is there's a stigma around it, right? There's a stigma around this for whatever reason it is. Many programs have a stigma around it. What I was hoping today is that the potential borrower understands, like any other mortgage, whether it's an interest-only loan. Some people a few years ago, I don't know why, they took those balloon payments. Oftentimes this can be used as a vehicle in life planning. As you get older, if you want to stay independent as long as you do, like my grandparents, they both lived into their 90s. They've been independent. This man still drives. He still gets up and goes to church. He still walks to the end of his driveway every day and gets his newspaper, right? So this is a tool and a vehicle. And although that there may be a stigma attached, like your people are trying to scam grandma and grandpa, if they educate themselves, they can actually use this as a tool where our parents and grandparents, no one wants to be a burden to anyone. They won't be a burden. They'll have their quality of life. They can live in their twilight years as they so choose without worrying about having to make a decision between household expenses, and things of that nature. So if someone wanted to get in contact with you to get more information, what is the best way they can contact you?
You can reach me by phone or email. My best way to reach me on the phone is 410-977-8870. You can call or text that number, or email is Neil, Neil, at lowrateloan.com. All
right. So I want to thank Neil for coming on today and sharing this information. As I always do with my potential clients and future clients, is education. And I want to apologize to Neil because when I was in the class, I kind of pushed them. We used the old Cadillac.
You
This is
did.
kind of, this is like the old leaky Cadillac, from the 70s. And I want to thank him, number one, for coming on, because education is the key. We are in a market now where you have to make informed decisions, because not everybody can function in this market. And as costs and things continue to rise and go up, as historically as they have, you have to make informed decisions. Now, one last question. This came up in the class. It was about the interest rate. Like, what was is it comparable? Is it plus one? Like, what is normally in a normal situation? What are we looking like?
It's comparable to what you see in the marketplace when rates were, a couple of years ago in the threes. We were right along there with it. The right now, high sixes, low seven. It doesn't track exactly with the traditional mortgage market, but it does align somewhat. These loans are, with a traditional mortgage, we know the term is 10, 15, 30 years, whatever it is. Here, the loans, technically speaking, are due when the last surviving borrower reaches age 150. So no one's ever gotten that close, but we don't know how long the loan will be outstanding. So that's why the rates are a little bit different, because we really don't know how long the loan will be in place. But the rates are comparable, and most of the loans we do, similar to the way traditional home equity loans work, are adjustable and fluctuate with the market. There's a cap, but so even our borrowers today, they're getting into it. As rates come down in the coming months, years, hopefully, they'll benefit from the decline in rates without doing anything, really.
Excellent. So again, I want to thank you so much for coming on today. I truly appreciate it, because I think that the information that you shared will open up a few lanes for people, because some of us are in some tight times right now. We have to make some decisions. And I just turned 50 this year. So as we age, we need to really begin to think about this next stage of life. And, living expenses is a major part. So again, I just want to thank you so very much.
I applaud you, Frank, for having this conversation. And, a lot of people are afraid to have the conversation because, they don't understand it. They don't want to talk about it. So kudos to you for even, for coming to the class and for doing this today. I appreciate it very much.
All right. So I'm going to go ahead and end this one here. And what I will do is I will be in touch.